Hi, this is Elliot Eisenberg of Graphs and Laughs, catching you up to date on what's going on in economics. And oh my gosh, there's so much to say. It's incredible. This is going to be a relatively long video. It's not a 2-minute video. It's going to be about a 15-minute video. And we're going to talk about macroeconomics and a whole bunch of stuff in coronavirus and so on. So sit back, relax, and enjoy yourself and take notes. Let's begin by reviewing our GDP equation. C, household consumption. I, corporate investment. G, government spending. And net exports. X. This is on slide number 2. They're all going to get worse with the exception of G. G should get better to make up for some of the loss of C primarily. I, they're going to have a hard time doing, and exports not. But C will be compensated by some increase in G. We'll talk about how much G we really need shortly, all right? But C is going to get weak all by itself. I is going to get weak, and X is going to get weak. Hopefully G will compensate for some extent. Now, how bad is coronavirus? On slide number 3, you can see there's a box. There's a box somewhere around a contagion level of each person causing 2 new people to become contagious, and the mortality rate on the left-hand side, right? And it's about 0.1 or so. So this is not a terrible thing. It's not. It's not good, don't get me wrong. It's worse than the flu. The problem is we have no inherent antibodies to it right now. That's the problem. So the number of deaths, if totally ignored, would be very, very high, roughly 10 times as much as the flu. Maybe more, because of the antibodies. I'm not an epidemiologist. This is a very scary prospect. So the key is to get the rate of as this goes through our economy to lessen, so that hospitals can manage. That's critical. If we have a big blip up, it overwhelms hospitals. That's not good. If we flatten the curve, the same number of people are injured or damaged or die, God forbid, but they do it over a long period of time. That's a much better outcome because we can help many more people in the process and not find our hospitals and healthcare workers overwhelmed. This is a very big deal, and that's why a lot of care is being taken in this area. The next question is how bad is this compared to other viruses that have been out there? And on this graph, you can see 3 different possible scenarios. On the far left, the Spanish influenza of 1918, and the middle, a bad one, not quite as bad as that one, of course, in the late 50s, and then on the far right, the late 60s. The working assumption here is that this is much more similar to the late 60s virus, maybe somewhere between the late 60s and the late 50s virus, so on the right-hand side, but not the middle. But nothing as bad as the center or left, because we know what's happening. We're going to get a vaccine and so on and so forth. At least that's the working assumption again. It may or may not be true. Now, the next thing is, how can you combat it? And it shows that China, despite not telling the truth way on and ignoring it for months, which has now caused this global problem purely because of Chinese unwillingness to admit the truth. But that having been said, they clamped down very, very hard once they found out about it. The South Koreans have clamped down very hard, and clearly they show us a glide path. If we clamp down hard, it does level off and total cases stop going up relatively quickly. If we don't do anything, it's a problem. You look at Italy in this graph, and the line for Italy is a gray bar, and it's sort of going up much more than it's going over. Not good. And the key thing for us to remember is that we're very early in this process, and as such, we don't know much. We don't know how severe it will be. We don't know how long it will last. We don't know how good our effects, how good our interventions have been so far. I'm a little worried. When Fauci says we've failed, that makes me quite nervous. Head of infectious diseases at NIH. So the jury's still very much out on this process, and that's giving markets an incredible amount of indigestion. That's the problem. Looking at the next slide, because of this uncertainty and the things that we've already experienced, which I'll get into, reduced number of people going to hotels and going on cruises and going on airplanes, the expectation is that there'll be a recession has gone up tremendously. Different measures show different increases in probabilities, but it's the 50, 60, 70, 80% range. Doesn't mean it will happen, and it may not. And if it doesn't happen, here's another slide showing another probability of recession closer to 75%. And it may well not happen, right? And if it doesn't happen, it's going to be primarily because of calendar quirks. We know January and February were very good. March could be very bad. It depends how bad it is. If it's not that bad, the sum of Jan and Feb, which are good, and March, which is crummy, together may still give us positive GDP growth. to get negative, to get a recession, you kind of need 2 quarters. Not literally, but that's kind of the general working assumption. Not the literal economic assumption, however. Q2 could be awful and Q3 could be good enough, and then we get out of it. If March is really terrible and it brings down the benefits of January and February, the March number so bad it brings it all into the negative territory, and Q2 is terrible, then by definition we've got a recession. Kind of the unofficial definition. Remember, the general definition is much more broad than that. So looking at some possible outcomes, it's reasonably likely that the Q2 number is going to come out absolutely dismally. Q1 against buffered because of Jan and Feb being good and March being bad. But Q2, we know April is going to be bad. We probably think May will be bad. We just don't know about June or May. We don't know. We just don't know enough to really know. But we know that Q2 starts off really, really badly. I think that's the point. And there are a couple of possible scenarios that I've put out in some slides here in numbers 8 and 9. No one really knows. These are just guesses, good guesses, but unknown. Europe, they're going to go into recession. There's no doubt on slide 10. That's just a given. Because they're already barely growing as it is, and Italy was already in a recession, teetering just before this began. Germany was teetering in a recession. France and England were doing badly and so on. So this is going to knock them over the edge. No question about it. And it'll knock Japan over the edge too, because they've had some bad fiscal policy and a typhoon. And now they have coronavirus. This is more than any economy can handle, especially a slower growing one like Japan. So you've got and China will have terrible Q1s. You've got China and Japan and Europe. And this is a lot of countries and areas of the country in recession. So it's not shocking if we end up in recession too. Hopefully we avoid it. Now, looking at reasonably current data, look at slide 11. What you see here is the Bloomberg Comfort Index. It's pretty good. It goes through early March, the first couple days of March. But then look what I show you next on slide 12. Here we show some very quick renewing data that gets us to the middle of March. And you can see the nosedive that occurs. So that nosedive is telling us March is going to be bad, along with presumably April and May, and we don't know exactly what, right? Similarly, if you look at the next slide, hotel occupancy rates, you can see they're getting progressively worse. There's really no doubt about that out there, right? You can see the red line really starting to curve down. So confidence is down, going to hotels is down, no question there. Expected airline revenues are way down. Airlines are pulling back on flights. I've had flights that are rescheduled because they're getting rid of planes left, right, and center. This is going to hurt as well. We're not going to take planes. We're not going to go on trips. We're not going to buy movies here on slide 15. You can see the purchase of movie ticket spending. You can see that line is starting to nosedive as well. So all these social activities, entertainment activities, leisure activities, they're simply not occurring right now. This is something to be concerned about. It's going to whack GDP, just as slide 16 is going to show us here. Look at this. This is restaurant traffic, and you can see all the way through late February, end of February, there was no noticeable, discernible change in attendance going to restaurants. And then suddenly come March 1st, it's like the lights went out, and suddenly the decline starts to take off, and it builds up steam. Now, these are in some of the more affected areas, it's true, but you can see declines of 40 and 50% in some cases. So this is telling us there's something going on here, and we should expect a crummy March and certainly a crummy April. And if all goes well, by the end of April, that's 45 days from now, we begin to get a handle on this. This is going to get worse before it gets better. We're just in the beginning of this process. This is what's somewhat concerning. So you put it together, C is going to decline. There's no question. How much it's going to decline, we don't really know. But, couple percentage points for sure. So this is why we know we're going to have a very sharp decline in economic growth. Whether it causes a recession, again, depends on calendar quirks and how long it's sustained. And those are unknown at this point. But I can promise you a really crummy March and a really crummy April. That's for sure. Now, business confidence, through February, pretty much it was good. Or middle February, it was really good. This is data put up by the National Federation of Independent Business. Good news. But if you extend it and look at more frequent data from other sources, you can see much weaker data if you bring it forward into March. So the March data, again, we keep seeing over and over again, it's bad. And on top of that, if you add to that the energy problem that we've got between Russia and Saudi Arabia, that are trying to hammer each other over the head, and in the meantime, as a collateral damage, destroy U.S. fracking activity, that lower price of oil, sure, it helps consumers, but it's going to do terrible damage to corporate investment in plant and equipment, just like it did back in 15 and 16. And it almost drove us into a recession then. So this decline in energy prices, while it used to be good news 5-10 years ago, isn't good news now. So that's also a problem. So we have a trade problem, we have energy problem, we have coronavirus. There's a lot of things going on. Here's oil prices in this slide. Corporate profits clearly aren't going to be going anywhere in 2020. That's not going to be a boost to the stock market. Corporate earnings aren't going to help. And another thing to worry about that markets are concerned in the stock market and the bond markets are concerned about is BBB corporate debt. This is debt that's just above investment grade. And the problem is if they teeter, if incomes fall a little bit, they lose a few little customers, some revenue declines, and their bonds have to be downgraded to BB from BBB, they're no longer in the investment grade category, they're now junk. And if they're junk, a lot of firms can't invest in them. Interest rates start to spike, the credit cycle, the credit tightening happens quickly. These firms go bankrupt, they fire their workers. It's a really bad problem. So this is another fear that's out there that's sort of in the back, the nightmare scenario for firms and investors and firms. We know that manufacturing, on this slide 24, clearly isn't going to be going anywhere right now. Supply chains in China are being adversely affected, in South Korea and Japan and so on is a problem. Factory utilization rates in slide 25 are going to continue to decline. No investment in corporate plant and equipment. It's not going to happen. So you see slide 26, it's going to continue to decline, and it will decline more quickly. That's why we know March and April are going to be absolutely horrible months, right? Now, government's absolutely critical to this story. Government can come in and compensate for this decline in C with targeted fiscal policy. We'll talk about the Fed lowering interest rates by a percentage point. That's economy-wide. But fiscal policy can be tailored to unemployed people, to people in firms who've lost their jobs, who work in the restaurant, hospitality, and cruise ships, and rock music bands or something, who aren't going to get work. These people need to know that they're not going to be out of money simply because of a virus. Right, and they've had to social, disconnect and social distancing and all that stuff. So the Treasury's got to come in and do this. Now, we've had an $8 billion proposal thing happening and a $50 billion thing. I'd like to see something on the verge of between 1% of GDP and 2% of GDP. That's between 200 billion roughly and 400 billion. Call it 300 billion, 1.5% of GDP. Some big thing like that telling us we're going to try and help all people who are adversely affected. That will push up C by jumping up G, and that will help buoy our economy in the short-term spell when a lot of consumption is going to go down just because people lost their jobs in the short run. We also have, in terms of exports, that's not going to be any good. They're not buying, we're not buying, they're not selling, we're not selling. We can't get parts, they can't get parts. This is not going to be a contributor to GDP by any stretch of the imagination. And the dollar's stronger, and we have a trade war. But if you look at slide 30, contemporaneously through the end of Feb, things were still fine. So we know we have 2 good months, we have 1 lousy month this quarter, and next quarter is really going to be where the Vigoro hits the mix master, as they say, right? As for rates, well, the Fed just dropped them on slide 32. They're down at 0. And Powell said he hopes to ever go negative. He says he wants to use forward guidance, telling us, well, we're not going to raise rates for another year or 2 or 6 months and do more QEs. He's done now. He's done $500 billion of Treasury purchases, $200 billion of mortgage-backed securities purchases. So he's flooding the market with liquidity, trying to make the market not go up, just work properly and have liquidity available for investors to go in and out and not have bottlenecks, because that's even worse in a stressful situation. You want things, the mechanics, the plumbing, not to give out. This will solve that. As for housing, the issue here looks decent. It really does. It's much less bad than could be perceived. First, on slide 34, searches for people looking to buy a home are pretty good, right? This is still early in March, but it's still okay. So people are knowing no interest rates are low. People still need to buy a house. So altogether, this is not a bad thing. We know existing sales, anecdotally from what I've heard, have been okay. There hasn't been a tremendously bad number drop. The mortgage bankers are predicting a mortgage, not refi, but first-time mortgage apps are going to go up a little bit because rates are down. So there's general consensus that this will be okay and hopefully a little updraft because interest rates are so low. Here's first-time mortgage apps. And they've been okay. There's been no noticeable decline yet. This is weekly data. This is through March 4th. So it's okay here. Let's cross our fingers. Refi is absolutely spectacular and out of control. Enjoy the refi wave for as long as it lasts. Don't know how long it'll be, but it's been absolutely spectacular. This is as good a refi wave as we had 12 or 13 years ago. Remarkably good. Enjoy every minute of it. As far as the gap between 10-year treasuries and mortgage-backed securities, it's certainly widened of late, as you see on the far right of the graph. There's a fear that we'll go into recession and defaults will go up. There's a fear that people will prepay, and that will hurt investors and reduce servicing rights. And there are a couple other, and there's of course the tightening of spreads across the board. Everywhere there's tightening of spreads. Treasury is the best. And everything is more risky than that. So everything that's more risky than that, the spreads widen because financial conditions have tightened. Hopefully the central bank's decisions of today, where they lowered rates by a percentage point and did quantitative easing and so on, a couple other things that they've also done, hopefully helps this. I'm not sure it will. Panic still is quite pervasive, but if panic calms down, this will hopefully help and reduce these spreads and make. And of course, we're also very busy. So how much can we actually do? How many mortgages can we actually make at this point? We're so overwhelmed and swamped. I hope this has given you some food for thought. We know this is a serious problem. We know we're not out of the woods by any stretch of the imagination. We're really entering the woods right now. It's going to get worse. March will be bad. The rest of March will be awful. April will be awful too. The question is, how much longer than that? How far into May, and hopefully not, God forbid, June, we have this bad news? That remains to be seen. The longer it goes, of course, in high stress, bad situation, the more likelihood we have to end up in a recession. I think we can skate through Q1 without negative GDP, but Q2 is going to be just plain awful. I look forward to speaking to you again in a couple of weeks. Thanks very much for your time.